Welcome, everyone. Today, we're exploring a landscape that's just evolving incredibly fast, FinTech innovation. And before we really get into it, just a quick note for anyone interested in professional development. If you engage with the quiz that accompanies this discussion, you can earn zero point 0.5 CPD points towards your certification. So definitely check that out afterwards. Right, FinTech, financial technology. It's more than just a buzzword, isn't it? It's fundamentally changing the whole global financial scene. We're talking about finance meeting tech head on, delivering solutions that are faster, more efficient, and really focused on the customer. Think mobile technology, cloud computing, data analytics, AI. They're all reshaping how we deal with money. Today, we're going to look closely at four really influential areas: new payment solutions, robo-advisors, peer-to-peer lending, or P2P, and challenger banks. Our goal here is to pull out the key insights, maybe find some aha moments, and just make clear what all these changes mean for everyone, especially if you're a financial professional.
That's a great way to put it. And it's so important to see fintech has really moved from, the edges right into the core of financial services today. It's changing everything, how we pay, invest, lend, borrow. It's not just a small shift, it's a real challenge to the established banks and institutions. We're seeing totally new players, new business models popping up. And of course, that brings in complex questions for regulators. There's this huge demand globally and definitely here in South Africa for digital financial services. But regulators have this tricky job, right? They need to encourage innovation because it boosts the economy and access, but they also have to protect stability, keep data private, and look after consumer rights. It's a real balancing act.
The high stakes balancing act, absolutely.
Mhm.
So, okay, let's start with maybe the most fundamental interaction. New payment solutions. How we actually pay for things. We've moved from, well, slow, sometimes paper-based systems to something that's much more real-time, smooth, and secure. Think about it, going from writing checks or waiting for deposits to clear to just using mobile wallets like Apple Pay, Google Pay, or local favorites like SnapScan and Zapper. And here in South Africa, we've got great examples like Ozao and Mukuru really changing things for everyday payments.
It's a complete shift in thinking. Real-time and contactless payments, they're huge. We're talking 234/7 availability for transfers. That cuts down reconciliation time, boosts cash flow for businesses. It's massive. And contactless using NFC, near field communication, the tap and go thing, that's just standard now. It's faster. Customers expect it. Locally, South Africa's Rapid Payments Program, the RPP, is a big deal. It's a joint effort for instant, cheap digital payments, really vital for financial inclusion, bringing more people into the formal economy.
Inclusion is key. And with everything going digital, security must be top of mind.
Oh, absolutely paramount. Biometrics, fingerprint, Face ID, voice recognition, they're becoming common. But even more interesting is how AI and machine learning are being used. They're not just reacting to fraud, they're proactively spotting and stopping it in real time. And that ties directly into strengthening things like KYC Know Your Customer and AML, anti-money laundering rules.
Proactive, not just reactive. That's a big step. And speaking of disruption, we can't ignore blockchain and cryptocurrencies, can we? Bitcoin, Ethereum. They promise these borderless peer-to-peer payments with lower fees, cutting out the middleman. Adoption's still evolving, especially here, but globally,
Yeah.
it signals a different future for money movement.
It certainly does, and that's partly why central banks, including the South African Reserve Bank, are seriously looking into central bank digital currencies, or CBDCs, trying to get the benefits within a regulated system.
Right? And then there are super apps like WeChat Pay or Alipay globally. They're not just for payments. They're whole ecosystems, payments, banking, shopping, social stuff, all in one place.
Exactly, and we're seeing that trend take hold here too, with apps from Capitec, Vodapay, MTN's Momo, pushing embedded payments, making finance just part of other activities.
So much innovation. How are the regulators keeping up?
Well, they're trying. It's a constant game of catch-up. Authorities like the FSCA and the SARB here are actively building frameworks to govern these new systems, deal with data protection, license new players. So what does this all mean for financial professionals? It means you really need to understand this new landscape, not just be aware of it. You need to advise clients on new ways to transact, make your own operations more efficient using these tools, and make strategic calls to stay competitive. It's about staying relevant, really.
Staying relevant, powerful point.
Uh-huh.
Okay, we've talked about money moving. Let's shift to how money grows investments, and specifically robo-advisors. This feels like another area where tech is really democratizing things, opening up wealth management. So what exactly is a robo-advisor?
Okay, so basically a robo-advisor is a digital platform. It gives you automated financial planning advice using algorithms with very little human input needed, initially at least. How it usually works is you go online, fill out a questionnaire. It asks about your risk tolerance, your financial goals, how long you plan to invest. And based on your answers, the platform recommends and then manages a diversified portfolio for you. Typically, these are made up of low-cost ETFs, exchange-traded funds.
Ah, ETFs. Okay.
What's really fascinating here is how they've lowered the barriers. You often don't need a huge amount of money to start, unlike traditional advice sometimes. So sophisticated strategies become accessible to way more people.
So it's taking complex theories, like modern portfolio theory, and automating them.
Precisely. They use principles like modern portfolio theory to build the portfolio, often favor passive investing, and crucially, they offer continuous rebalancing.
Balancing.
Yeah, making sure your investments stay in line with your original goals over time. Some even do tax loss harvesting, selling losing investments to offset gains elsewhere, which can lower your tax bill.
Clever. Any examples we should know?
Globally, you have giants like Betterment and Wealthfront. Here in South Africa, we've got pioneers like Satrix Novia, Easy Equities, 10x Investments. They're making investing much more affordable and easier to access. Their big draw is transparency and low cost. Fees are often around, say, 0.25% to 0.50% a year. That's usually much lower than traditional advice fees.
The benefits seem clear then. Accessibility, cost savings, consistency algorithms don't panic sell, and they can handle lots of clients easily. But
Yeah.
where do they fall short? Is the human advisor obsolete?
That's the million-dollar question, isn't it? And no, I don't think so. Robo-advisors are great for straightforward goal-based investing, accumulating wealth, saving for a deposit, but they generally don't handle complex situations well. Things like intricate estate planning, setting up trusts, specialized tax advice, planning for business succession, that needs a human touch. And maybe more importantly, think about market crashes or big life changes, divorce, inheritance, retirement planning. People often want human reassurance, empathy, someone to talk things through with. An algorithm can't really provide that.
That human element.
Exactly, which is why we're seeing the rise of hybrid models, combining the efficiency of digital tools with human oversight and advice for the complex parts.
Best of both worlds.
Potentially, yes. It frees up human advisors to focus on higher value tasks. Behavioral coaching, building relationships, complex planning, while tech handles the routine stuff and ensures compliance. But this raises an important question about skills. Professionals now need to be digitally savvy, understand behavioral finance, oversee compliance for these tools, and customize advice. The role is definitely evolving.
Evolving roles. A recurring theme. Okay, let's move to another area that's shaking things up. Peer-to-peer lending, or P2P. This sounds like it cuts out the bank as the middleman in lending.
That's pretty much the idea. P2P platforms connect borrowers directly with people or institutions willing to lend money. They operate online, using their own algorithms to assess creditworthiness. These algorithms often look at different data points than traditional banks might, which can mean faster approvals and potentially better rates for borrowers and decent returns for lenders.
So it bypasses the bank's traditional role.
In essence, yes. Globally, you've got platforms like Lending Club and Prosper that have handled huge volumes. Here, Rainfin and Lulalend are notable examples, especially for helping SMEs and individuals who might find it harder to get loans from banks.
So the upside seems strong. Easier access to credit for borrowers, especially those overlooked by banks. Lower rates, potentially.
Yes, often. And faster processing times.
And for lenders or investors.
Attractive potential returns compared to, say, savings accounts, a chance to diversify their investments, and more control over where their money goes, choosing specific risk levels.
And for the market overall, more competition.
Increased competition, definitely. Democratization of finance, making credit available more broadly. And it pushes the use of alternative data for credit scoring.
Okay, sounds good. But here's where it gets interesting, I imagine. There must be risks involved when you cut out the traditional checks and balances.
Absolutely. The risks are significant and need careful consideration. Number one is credit risk. The borrower might default, and unlike a bank deposit, there's usually no government insurance or significant collateral protecting the lender's money.
So lenders could lose their capital.
They could, yes. Then there's platform risk. What if the P2P platform itself goes bust or is poorly run? Lenders might struggle to get their money back. There's also liquidity risk. It might be hard for a lender to sell their loan investment quickly if they need the cash back early. There isn't always an easy secondary market.
Right, you're locked in.
Potentially. And finally, regulatory risk. The rules around P2P are still developing in many places, South Africa included. Regulators like the FSCA and the NCR are watching closely. Key issues are ensuring platforms are transparent, preventing dodgy practices, protecting user data, and managing fraud and money laundering risks. It's complex.
So what does this mean for professionals?
Well, if you're a credit analyst, you need to understand these new lending models. If you're an advisor, you need to guide clients on whether P2P fits their risk profile and diversification strategy. If you're in compliance, you're navigating these evolving rules. If we connect this to the bigger picture, P2P lending is part of that larger trend we mentioned, disintermediation, cutting out the middleman.
Disintermediation, yeah, that really captures it. Okay, final category, challenger banks. These sound like they're directly taking on the big established banks.
They absolutely are. Challenger banks are essentially new banks, fully licensed, but built from the ground up with a digital-first, often digital-only model, no branches or very few.
So they have a full banking license, unlike some other fintechs.
Exactly. That's a key distinction from neobanks, which often partner with licensed banks. Challengers are the licensed bank. Think Revolut or N26 internationally. Here in South Africa, we have Time Bank, the first fully digital one here, Bank Zero with its no monthly fees approach, and Discovery Bank using that behavioral model linked to Vitality. Each has its own unique angle.
What's their main appeal? Why are customers switching?
Several things. Lower fees, usually much more transparent pricing. Onboarding is typically way faster and simpler. Open an account on your phone in minutes. They often offer innovative features built in, AI giving spending insights, easy budgeting tools, instant transaction alerts. It feels more modern, more personalized. And crucially, they're playing a role in financial inclusion, making banking services accessible and affordable for communities that might have been underserved by traditional banks with physical branch costs.
Sounds very attractive for consumers. But building a bank, even a digital one, that can't be easy. What hurdles do they face trying to scale up and compete?
No, it's incredibly tough. Regulatory compliance is a huge one. They still have to meet all the strict rules, KYC, AML, capital adequacy requirements like Basel III. That's expensive and complex.
Profitability must be a challenge, too.
Yes, profitability pressures are intense. Many start with low-fee current accounts, which have thin margins. Making sustainable profits often means moving into lending or other higher-value services, which takes time and capital. Cybersecurity and data privacy are constant critical risks. Being digital only makes them a prime target, and a major breach could destroy trust.
And trust is key, isn't it? Without branches.
Building customer trust and loyalty without that physical presence can be a challenge, especially for older demographics or for complex banking needs. People sometimes still want a face-to-face interaction.
How are South African regulators handling them?
It's a balanced approach, generally. The Prudential Authority and the FSCA ensure they meet the necessary standards for stability and consumer protection. But they also foster innovation, sometimes using regulatory sandboxes to let new ideas be tested safely. For professionals working in or with these banks, it means needing strong digital banking skills, understanding customer experience design deeply, robust compliance and risk management capabilities, and often fostering partnerships. Challengers frequently team up with other fintechs or even telcos.
What a fascinating overview of these key areas. It really hammers home that fintech isn't just about new gadgets or apps. These are fundamental structural shifts, changing how financial services work, how they're designed, delivered, and how we experience them. And the benefits are clear, right? Better access, more efficiency, greater personalization for customers.
Absolutely. But alongside those opportunities, we have to acknowledge the new risks. Regulatory frameworks lagging behind innovation, ever-present cybersecurity threats, and tricky ethical questions around things like data ownership or potential bias in algorithms. And, of course, the ongoing question about automation replacing human roles. For any financial professional listening, the implications are huge. It's not just about your core financial knowledge anymore. You need to be fluent in digital tools, understand data, be aware of cyber risks, think about customer experience, all while holding on to your ethical compass. This raises an important point. Continuous learning, being agile, adaptable, these are becoming just as vital as your traditional qualifications.
Which brings us back to CPD, continuing professional development. It really isn't just ticking a box for compliance anymore, is it?
Not at all. It's strategic. Engaging with this stuff, discussions like this, reading, taking that quiz we mentioned, it's how you stay informed, relevant, and ready for whatever comes next.
So here's a final thought to leave you with. The future of finance is clearly going to keep evolving, probably faster than we expect. The real question isn't if fintech will change the profession, but whether professionals will adapt and change with it. Through that commitment to continuous learning, you can ensure your skills, your knowledge, your credibility stay dynamic, stay valuable. Thank you so much for joining us today. Please do check out the accompanying quiz to earn those 0.5 CPD points. Until next time.